Hello, I'm Bill Glaser, Executive Vice President of Portfolio Management, Co-Chief Investment Officer, and a member of the firm's Investment Policy Committee. As we sit here today, there's lots going on in the world, from geopolitical uncertainty to lots of optimism tied to AI, tariff negotiations, market volatility, and so much more. So let's get started. The first question here has to do with AI in the job market. And it says, headlines keep warning about AI-fueled layoffs. What is Fisher's take on this? Well, this is a question I get all the time. And, the simple fact of the matter is, AI, you can think of AI in some ways as that next industrial revolution. And yes, there will be job losses. And in fact, you're seeing them here. I've heard of them. I know people personally that have been negatively impacted by that. But as with all these big industrial revolutions, it's going to create some short-term winners and losers. And in the long term, it's going to create more jobs than in the short term jobs that are destroyed. And, there will be this short-term disruption as, employees today have to come to grips with learning new skills to deal with AI and the capabilities in therefore. But, I always like to say, don't think about innovation as a zero-sum game, right? Really what you're seeing is this innovation with AI, and it's going to really drive down prices, creating more demand, creating more jobs today and in the future that we couldn't even have fathomed, 6, 12, 24 months ago. And so that's going to take time for, the job market to work its way through some of that disruption. But longer term, our economy, the markets will be better off for it. So the next question here has to do with the prediction markets. It says, how does Fisher think about prediction markets? Well, we do look at the prediction markets, but we do so more in the sense of a sentiment tool, right? But, if you think about the rise of these prediction markets, in some ways, I think of it as a new financial innovation. And with all new financial innovations, you need to be a bit careful with them, because you need to really dig in and try and understand what are the potential unintended consequences. And because you can draw out some potential unintended consequences and some perverse incentives that bad actors might have as it relates to some of these prediction markets, and what that might mean for capital markets. So we think of it not only as a sentiment tool, but we think of it in terms of a risk and what are some of the unintended consequences. Think about other previous financial innovations that have come about in the past. And, I go back to 2008 and the financial crisis, think about credit default swaps or CDSs, and think about how some hedge funds use them in unintended ways. I mean, credit default swaps have been around for a long, long time. But in 2008, they were used in unintended ways by hedge funds for what's called a bear raid, where, these hedge funds are buying up the CDSs and shorting the stocks at the same time, making spread on both sides of that trade. And so, that created a lot of problems and a lot of issues. And so I bring that up as a parallel and an example. And really, as you think about these things, whether it's prediction markets or otherwise, to really try and understand and challenge yourself to figure out what are some of the unintended consequences. Now, the next question here has to do with OPEC. And this is a real good question. And it says, can you share Fisher's thoughts on the UAE's decision to leave OPEC and how this might alter global energy markets? Well, I think longer term, it's bullish for energy supply, energy production. And if you think back, OPEC was created and came about in the 1960s, and really it was designed for these oil-dependent states and countries to come together to use their collective leverage to try and influence energy markets and so forth. And you fast forward 60, 70 years to where we're at today, and you take the UAE, for instance, and their economy is very, very different today than it was 60, 70 years ago. It's much more diversified. They're not entirely oil dependent. And in fact, energy accounts for, about a quarter of their total economic output. And they've been able to really diversify their economy over that time frame. So you say to yourself, how much do they really need OPEC today relative to the past? And in some ways that helps you understand the incentives behind the decision that they did make. But, in addition to that, Abu Dhabi has spent billions and billions of dollars to build out their energy capacity. And, going into the war, the UAE was producing about 3 million barrels of oil per day. They have the capacity, or will have the capacity in short order, to produce about 5 million barrels of oil per day. And so there's that output gap, or that potential capacity that's really not being used that they would like for it to be used. So why be beholden to OPEC and some of the constraints that they place? And so as the war sort of works its way out, and as the Strait of Hormuz sort of works its way out longer term, it wouldn't surprise us to see the UAE increase some of their energy or oil production. And as I mentioned, longer term, that's a bullish feature for the energy markets in terms of increased supply. And the next question here is, can you comment on the latest U.S. tariff developments and the potential market impacts? Well, boy, I don't think a day goes by where you're not hearing something about tariffs, right? Either the courts striking some or part of them down, or maybe getting tariffs revised here, new tariffs there, and so on and so forth. And so, but you really ask yourself, what's been the market impact of all that? And the answer is, it's been real hard to discern, right? And the reason is because we believe, the tariffs, regardless of what happens, really lacks that surprise power. I mean, investors have largely become used to, some of these changes and the incremental changes. And so it really lacks any lasting market impact, as we see things evolving moving forward. But take yourself back to April of last year when all of this unfolded. I mean, we outlined 4 potential paths forwards. And we said, you might get sufficient pushback from Congress or the courts. You're seeing some of that. You might get some trade deals being enacted. We've seen some of that. You might get some retaliation. We've seen some of that. And then the fourth was one that I think at the time people just couldn't fathom. And that was maybe perhaps the tariffs, instead of restricting global trade like everybody anticipated or had predicted, it actually increases global trade. And that's exactly what we've seen so far as the tariffs have unfolded. And in fact, particularly outside the United States, because it has incentivized countries outside the United States to trade with one another. And if you look at global trade outside the US, it's accelerating. It's high and rising, whereas trade, with the US and other countries has been relatively flat. And I think that's a huge underappreciated feature, and one that, 12 months ago people couldn't really fathom. But as you think about those 4 scenarios, I think any one of those can continue to play out as we move forward. But in terms of the market impact, I really think that's yesterday's news, and there's really no there. Well, that's all we have in terms of questions. Thank you for watching, and have a wonderful day.